Welcome back to the Financial Interest YouTube channel. My name's Dan. So in this week's video, I'm going to talk about some of the risk factors that you're going to find when you're looking to invest in individual companies. And whenever we invest, we're always going to be taking some sort of risk. And obviously the idea is to mitigate the risks as much as possible and reduce them to a level which is acceptable for us. So let's get on with the video. So there's literally hundreds of different risks associated with investing in the stock market. I'm not going to go over all of them. I'm just going to mention a few of the main ones that I look for. And also another good place you can find risk factors in a particular company would be going to look at their 10K, because it's part of what they have to file with the SEC for them to name any kind of risk factors associated, so the investors have all the possible information to make a decision. So let's look at headline risk, and this is something I also call events risk. So obviously this is the chance that the company you're looking at or the industry has an event or headline which actually causes the price of the stock to go down. And these events can be kind of anything. So you can look at obviously the pandemic that's just happened, caused a crash in the markets, also the global financial crisis and things like that. And there's also other events which are industry specific. So for example, if you look at the Fukushima nuclear plant disaster, then obviously that had wide-reaching consequences for all companies dealing in nuclear energy, not just in Japan. And moving on, you'd also get individual events within companies. So think of something like the BP Deepwater Horizon disaster in 2010, when they had the oil spill in the Gulf of Mexico. Or you can also look at the VW scandal that broke in 2014, 2015, when they'd actually developed a piece of software to cheat the diesel emissions tests on their cars. And obviously all of these things, when the news comes out, they have a really big negative impact on the stock's price. And if you look in the case of BP, their price dropped considerably and it's never actually recovered since. So this is one of the key risks you need to look for when analysing any business. But also be aware that this is actually something we look for to get an entry opportunity into the company, because we want to invest when they're at their lowest kind of price possible. But also we need to know that they will actually recover. And in the case of BP, as we just mentioned, that's actually not happened yet. Another major risk would be the risk of the company becoming obsolete, or the products and services it sells becoming obsolete. And this will happen a lot with disruptive technology coming along and kind of taking away the market share of previously successful companies. And you can think of companies like Blockbuster, who had a huge market share in the 80s all the way through to 2000, but they failed to kind of see the way things were going with how people consume video content. And obviously they had an opportunity in 2000 to actually buy Netflix for $50 million, which they declined on. And obviously now you can see that Netflix has become a huge company, and Blockbuster filed for bankruptcy in 2010. Then we're moving on to legislative risks. So this is the risk that legislation changes within a country, or the government sets out different guidelines. And this can happen a lot. You've just recently seen it in China, where they've kind of been clamping down on the big companies over there, such as Alibaba and Tencent. And they also banned education companies in China running for profit as well. So this is something you need to be aware of when you're looking into companies. This would also be the case with the antitrust thing going on with the big 5 tech companies in the US, which is Apple, Amazon, Google, Facebook, and Microsoft. And this can also be a sign of monopoly, so the government might act to try and break up those monopolies because it's not in the best interest of the consumer. Other examples of legislative risk would be things such as the government passing a bill on green energy, which means the oil companies need to pay more on kind of carbon tax and things like that. This is all something you need to kind of be aware of and look through in the company's filings. Similarly, if you're investing in developing countries, you might have political risk. If the government is not stable, what might look like something that's a really good investment could actually be highly risky if something happens within the government, if there's a military coup or something like this in one of these countries. That can have a huge impact on your stock. They might actually just take the money, who knows, with that kind of thing. So there's another risk, which is detection risk. And obviously, whenever companies are filing their reports, there's an auditor who goes in to make sure that those reports are correct. And there's always a chance that the auditors miss something or it's well hidden from the company, and maybe there a fraud has been committed. Now, a good example of this is the whole Enron scandal where they'd been cooking the books. And I recently watched a good video on that from Cold Fusion's channel, so I'll leave a link to that if you want to know more about exactly what happened with that. So there's also a currency risk, and this is if you're investing in a different country to where your brokerage account is. So you will invest, and obviously you might be making money. You say you've got 10%, 15% returns in the country you've got the money invested. And by the time you convert that back to your kind of currency that you're working with in your home country, you might actually find that because of the fluctuation in the currency, you might be making considerably less because of that actual currency exchange. So you also need to take this into account when investing in foreign countries. And you'll find other risks such as concentration risk from having too much money invested in certain markets or individual companies. I'm not going to go into great detail in that now because that's probably actually a topic completely on its own. And also liquidity risk if you're trying to get into an investment or out an investment that doesn't have a lot of liquidity in the market. So if you look at assets that are illiquid, that would be something like rental property. You can't just sell it and liquidate to get the cash straight away. It will take you time to get out of that. And it's the same thing if you're investing in stocks. If you're invested in very small companies that don't have much kind of many people buying and selling the shares, then it's going to be difficult for you to get out at the price you want. But let's not overcomplicate things here. The real risk is always going to be losing money. So all of these risks will come down to the fact that we'll either lose all of our money, lose some of our money, or we won't make the returns we're looking for. And this is, if you really want to simplify it, the actual real risks that we've got. And here, the preservation of capital is the key. Remember, if we've got an investment and it drops by 50%, then for us to get back to where we were before, we need a 100% increase. So it's much easier not to lose the money in the first place than to have to try and chase really huge returns like that. And we have two main layers of protection for this when we're investing. The first one is knowledge and understanding of the business. And there's a couple of good things to look at from Warren Buffett with this. So the first one is risk comes from not knowing what you're doing. This sounds simple, but it's so true. We should only invest in things that we're capable of understanding. If we don't understand, then we don't invest. It's simple as that. And our second layer of protection is the margin of safety. So let's look at the knowledge and understanding part. The first thing is we need to be looking within our circle of competence. So this is something that we can understand. The business is familiar to us. We have a lot of experience with that business. So this is kind of the first stage. And then the second stage is the business needs to have a moat. So it's got a durable competitive advantage that protects it from its competitors. And this will show itself in key numbers such as sales growth, earnings per share growth, the growth of free cash flow, and also increasing assets as well. And then next we're looking deeply into the management team. Are they aligned with the shareholders' values? That's one of the key things to look at there. We want to see good returns on equity and invested capital. And also we want to see a minimum amount of debt, ideally no debt at all. And once we've got all this information, we need to put a valuation on the company. And this is done usually with something like a discounted cash flow analysis, because it's really key that we can actually value the company, because then this brings us on to the next stage, which is the margin of safety. And this is our second layer of protection. So once we've got our valuation, then we apply a margin of safety to that valuation. Now, this might be something like 50%, or it could be a little bit less depending on our knowledge of the company and industry. So for companies we've got a lot of confidence in, we might be happy to do a 30% margin of safety, whereas our normal margin of safety will be 50%. For kind of less certain industries where we feel like it's a little bit more risky, we might demand a higher margin of safety, maybe something closer to 70%. So now let's look at how the knowledge and margin of safety can help us with some of those risks I mentioned before. So in the case of headline risk, where we've kind of seen an event, we want to be sure that the company is kind of able to bounce back as soon as possible from that event. So with this, we're looking at the management team. Do they have a track record of kind of directing the company through previous events. You want to go back and look over quite a lot of years of data so you can see how they survived the financial crisis and things like that, and perhaps other individual events which have happened within the company. And this is where it really helps to have a good cash cushion on the balance sheet, because you might end up in a situation, for example, if you look at the pandemic with the cruise lines and things like that, they had to shut down operations completely and take on a lot of debt. And obviously they weren't really in a position to negotiate favorable terms on the debt because of the scenario that they were in. And if they'd had a cash cushion, they might have been able to ride everything out a bit better than they did, instead of having to take on large amounts of debt. And in terms of the obsolescence, you will see this manifest itself in profits decreasing over time. So you'll see probably sales will shrink, and then also the earnings per share. You want to be careful that they don't try and manipulate that too much with share buybacks and things like that. And also the free cash flow might be shrinking. Margins are probably getting smaller as well. And this shouldn't be something that happens immediately. You'll probably see this kind of over a period of time. So if you see steadily shrinking things across all of those areas, then that's the kind of sign that the company might be becoming obsolete, or the moat is certainly like shrinking at this stage. And I'd say with the legislative and political risk, you just need to be a little bit more careful when you're investing in companies who've got these kind of things. So if you're investing in a different country, maybe you're going to demand a bit more of a margin of safety for this, or closely keep an eye on the different legislation that's coming through if you're an investor in certain things, like in industries that move quite quickly, like the technology industry, medical industry, and things like that. And for detection risk, it's very difficult. I don't know who would have really spotted the whole thing going on in Enron, but one of the key things you can do is listen to the earnings calls and how management actually answers any questions they've got, because this is going to give you some insight into like what the CEO and the other important executives are actually trying to hide, or if they're quite truthful about what they're saying. And you can also look at the proxy statements at this stage, see their compensation package, and make sure it aligns with the shareholders' kind of values as well. And also a good way to look at this is from reviews on Glassdoor. So as you can see from some of the risks I've outlined during the video, there's actually quite a lot of different risks, but obviously these can really be mitigated quite significantly just by the knowledge and understanding of the business, and making sure you require a large margin of safety before making any investment. And then you need to remember Warren Buffett's rule number 1, don't lose money. Always think of that before you're going into any investment. And I'll just mention one really important risk before the end of the video, and that's not investing at all. Obviously, we've looked at all the risks associated with investing, but probably one of the biggest risks would be not to invest at all. And this is really due to the risk of inflation. Just saving money is not going to be enough to get you to financial freedom. You need to actually invest that money and grow it at a certain rate to be able to reach that point. And this is why investing is so important in the first place. Obviously, your money now is going to be worth less in the future because inflation erodes the purchasing power of money over time. So this is why you need to actually make sure that you're investing and growing your money that way in companies that are really inflation proof as well. So that's it for the video. I hope you enjoyed it. If you did, please give us a like. Also consider subscribing to the channel if you haven't already, and you can hit the notification bell to get notified whenever I'm releasing new videos. So please let me know any other risk factors that you look for when you're analysing a business. It's always interesting to hear like other people's perspective on this. So thanks for watching, and I'll see you in the next video. Cheers.